Is the Silver Tsunami creating a huge opportunity for healthcare REITs in 2026? Or is this just another dividend trap with a better story? That is the question investors need to ask carefully. On the surface, the bull case sounds powerful. America is getting older. Senior housing demand is rising. Healthcare usage increases with age, and REIT investors are always looking for long-term income backed by real assets. So healthcare REITs seem like an obvious winner, but obvious stories can still become bad investments. Demographics can create demand, but demand does not automatically create good returns. To understand the opportunity, we first need to understand what healthcare REITs actually are. Healthcare REITs are not one simple sector. They are several different businesses under one label. Some healthcare REITs own senior housing. Some own skilled nursing facilities. Some own medical office buildings. Some own hospitals. Some own life science labs. And some own outpatient facilities. Those property types can behave very differently. Senior housing is more operationally intensive. Skilled nursing can depend heavily on reimbursement and operator strength. Medical office can be more lease-based and stable. Hospitals can involve tenant concentration and complex lease structures. Life science real estate can be tied to biotech funding and research demand. And outpatient facilities can benefit from the long-term shift away from expensive hospital-based care. That is why investors should not say, "I like healthcare REITs," without asking which type. The drivers are different. The risks are different. The dividend safety profile can be different, and the growth opportunity can be different. Healthcare REITs are not one sector. They are several different businesses under one label. Now let's look at the demographic force behind the whole conversation, the Silver Tsunami. The Silver Tsunami refers to the aging of the American population. It is mostly driven by baby boomers moving deeper into retirement age, and the numbers are large. The population of Americans aged 65 and older is projected to rise from 58 million in 2022 to 82 million by 2050. That is a projected increase of about 42%. For healthcare real estate, this matters because older populations tend to need more healthcare services, more medical visits, more assisted living options, and more care infrastructure. This can support demand for senior housing, assisted living, medical office, outpatient facilities, and other healthcare real estate categories. But the demand does not arrive in a perfectly smooth straight line. It comes in waves. Different age groups need different types of care. So a healthy 68-year-old is not the same demand profile as an 88-year-old who needs assisted living. So the Silver Tsunami is not just about people getting older. It is about the real estate needed to support them. And in 2026, that real estate setup is becoming especially interesting. The reason 2026 matters is that senior housing is seeing a powerful combination. Demand is improving, but new supply is still constrained. According to NIC, senior housing occupancy reached 89.5% in the first quarter of 2026. That was up 0.4 percentage points from the prior quarter. At the same time, new units under construction fell to the lowest level since 2012, and year-over-year inventory growth was only 0.4%. That is important, because if demand is rising while new supply remains limited, operators may have more pricing power. Occupancy can improve, revenue can improve, NOI can improve, and healthcare REITs with the right assets may benefit. But this still does not mean every healthcare REIT wins. A strong industry setup can help, but execution still matters. Property quality matters. Operator quality matters, balance sheet quality matters, and valuation matters. The 2026 setup is powerful because demand is rising while new supply is still constrained. Now, let's go to the center of the bull case, senior housing. Senior housing is the main bull case for healthcare REITs in 2026. It has the most direct connection to the aging population. As more Americans move into older age groups, the need for independent living, assisted living, memory care, and related services can increase. And the current setup is attractive. Occupancy has been recovering, New supply is limited, and stronger operators may be able to push rents if demand continues to improve. You can see this in the operating numbers. Welltower reported senior housing operating same-store NOI growth of 22.1% year-over-year. Its senior housing operating revenue grew 9.5% year-over-year. Ventas reported senior housing operating portfolio same-store cash NOI growth of more than 15% year-over-year, and its SHOP revenue growth was nearly 9%. Those are strong numbers, but senior housing is not a passive rent collection business in the same way some net lease REITs are. It is operationally complex. Labor costs matter, staffing matters, operator execution matters, occupancy matters, pricing power matters. Senior housing may have the biggest demographic tailwind, but it also has the most operating complexity. Now let's look at one of the clearest examples of that opportunity, Welltower. Welltower is one of the most important case studies in healthcare REITs. This is not a recommendation, but it is a useful example of how the senior housing opportunity can show up in real numbers. In the first quarter of 2026, Welltower reported total portfolio same-store NOI growth of 16.4% year-over-year. Its senior housing operating portfolio same-store NOI grew 22.1%. Senior housing operating revenue grew 9.5%. Average occupancy improved by 370 basis points, and normalized FFO per share was $1.47. That is what investors want to see in a demographic thesis, not just a good story, actual operating improvement, higher occupancy, higher revenue, higher NOI, and stronger cash flow. But there is still a risk. High-quality REITs often get priced like high-quality REITs. If investors pay too much, even a great business can produce mediocre returns. So Welltower shows the opportunity, but quality often comes with a price. Now, let's compare that with another major healthcare REIT story, Ventas. Ventas is another major healthcare REIT to understand, and in 2026, it looks more like a recovery and senior housing upside story. Again, this is not a recommendation. It is a case study. In the first quarter of 2026, Ventas reported senior housing operating portfolio same-store cash NOI growth of more than 15% year-over-year. SHOP revenue growth was nearly 9%. Average occupancy growth was 310 basis points. Ventas also closed $1 billion in senior housing investments in the first quarter, and it increased its 2026 investment volume expectations to $3 billion, focused on senior housing. That tells us something important. Ventas is not just benefiting passively from the trend, it is actively allocating capital into the senior housing opportunity. That can create upside if the company executes well, but recovery stories still require discipline. Management needs to buy the right assets, use the right operators, avoid overpaying, and manage the balance sheet carefully. Ventas is a recovery story, but recovery stories still need disciplined execution. Now, senior housing gets the headlines, but healthcare REITs also have a more stable side. Medical office and outpatient real estate may not be the flashiest part of healthcare REITs, but stability can be valuable. These properties are tied to medical visits, procedures, diagnostics, outpatient care, and healthcare services outside the hospital. As the population ages, healthcare usage can rise, and that can support demand for medical office and outpatient facilities. The appeal is that these assets can be more lease-driven. They may have predictable rent streams. They may benefit from locations near hospital systems or high-demand medical corridors. And they may be less operationally intense than senior housing. But there are still risks. Tenant quality matters. Health system strength matters. Local competition matters. Leasing spreads matter. Cap rates matter. And not every medical office building is equally valuable. A property in a strong medical ecosystem can be very different from a weak building in a weaker local market. Medical office may not be the flashiest healthcare REIT segment, but stability can be valuable. Now, let's move to a segment where the yield can look attractive, but the risks can hide below the surface. Skilled nursing can look attractive because the structural need is real. Older populations may need more specialized care. Facilities can be essential, and some investors are drawn to the income potential. But skilled nursing often comes with higher risk. The business can depend heavily on Medicare and Medicaid reimbursement. Operators can have thin margins. Labor costs can pressure profitability. Regulation can change the economics, and the health of the operator can matter as much as the building itself. That is why the risk is often hidden in the operator. A REIT can own the real estate, but if the operator is financially stressed, rent coverage can weaken. If reimbursement pressure increases, margins can tighten. If labor costs rise faster than revenue, the business can become fragile. This is why investors should be careful with high yields in skilled nursing. A high dividend yield may reflect real risk. Skilled nursing can look attractive on yield, but the risk is usually hidden in the operator. Now, let's look at another healthcare REIT category with a very different profile: life science. Life science REITs are healthcare real estate, but they are not the same thesis as senior housing. This category includes labs, research facilities, biotech spaces, and scientific campuses. The long-term story can be attractive. Medical innovation, drug discovery, biotech research, academic and corporate science ecosystems, all of that can create demand for specialized real estate. But this segment can behave more like a growth and cycle story. It may depend on biotech funding. Vacancy can become a problem in weaker markets. Development can be expensive. Supply can build up in certain research clusters, and lease-up periods can be long. That makes life science different from the Silver Tsunami senior housing thesis. The demand driver is not simply aging. It is innovation, funding, research activity, and specialized tenant demand. Life science REITs are healthcare real estate, but they trade more like a growth and cycle story. Now that we have covered the main segments, this is a good place for a quick channel pause. This is the kind of REIT analysis we focus on at Boring Money Wins. Not just chasing dividend yield, not just buying a demographic story, and not just assuming every healthcare REIT will win because America is getting older. The goal is to separate the real opportunity from the hype. REITs, dividends, valuation, cash flow, operators, debt, and long-term demand. If you like no-hype REIT analysis that explains both the upside and the risks, hit the like button and subscribe to the channel. It helps the channel grow, and it tells YouTube to show more practical investing content to people who want long-term investing without the noise. Now let's talk about the risks investors miss when they only hear the words Silver Tsunami. The Silver Tsunami is a powerful demographic story, but a demographic tailwind is not the same thing as shareholder returns. Several risks can break the thesis. Labor costs can rise. Operators can be weak. Reimbursement pressure can hurt skilled nursing economics. Debt refinancing can become expensive. Interest rates can pressure valuations. A valuation premium can reduce future returns. Dividend payout ratios can become stretched, and regional oversupply can hurt occupancy and rent growth. This is the most important point. The demand can be real, and the stock can still disappoint. A healthcare REIT may own the right property type, but if the operator is weak, the results may not flow to shareholders. A REIT may benefit from aging demographics, but if investors overpay, returns may still be poor. A company may pay a dividend, but if the payout is not supported by cash flow, the dividend may become risky. So do not stop at the demographic story. A demographic tailwind is not the same thing as shareholder returns. That is why investors need a checklist. Before buying the Silver Tsunami story, investors should look at the numbers. Is NOI growing? Is occupancy improving? Are operators healthy? Is the dividend payout sustainable? When does the debt mature? Is the valuation already expensive? Is new supply limited? And is the demand real or just a good narrative? That checklist can protect investors from buying a theme without understanding the business. Senior housing can be attractive, but you still need occupancy and operator execution. Medical office can be stable, but you still need tenant quality and good locations. Skilled nursing can offer income, but you still need reimbursement stability and healthy operators. Life science can offer growth, but you still need demand, funding, and valuation discipline. The checklist turns the story into analysis, and that is the difference between investing and chasing headlines. Do not buy the silver tsunami story until the REIT numbers support it. Now let's talk about who healthcare REITs may actually fit in 2026. Healthcare REITs can make sense for certain investors. They may fit income investors who want real estate dividends. They may fit long-term REIT investors looking for demographic exposure. They may fit investors who want to diversify across REIT sectors. And they may fit investors who are willing to track fundamentals, not just dividend yield. But healthcare REITs are not for everyone. They may not fit investors who want maximum growth. They may not fit investors who cannot tolerate sector volatility. They may not fit investors who buy only because a dividend yield looks high. And they may not fit investors who do not want to follow operators, occupancy, debt, reimbursement risk, and valuation. A good healthcare REIT investment requires patience and monitoring. It is not just buying the phrase silver tsunami and waiting for automatic returns. Healthcare REITs can be a powerful satellite position, but they should not be bought blindly. Now, let's bring everything together into the final verdict. So, are healthcare REITs a huge opportunity in 2026? The answer is yes, there is a real opportunity, but it is not automatic. The silver tsunami is real, the senior housing setup is strong, occupancy is improving, new supply is constrained, and some leading healthcare REITs are showing strong NOI growth. But not every healthcare REIT is the same. Senior housing is different from medical office. Medical office is different from skilled nursing. Skilled nursing is different from life science, and each category has different risks. Valuation matters. Operators matter. Dividend safety matters. Debt matters. Asset quality matters, and business model quality matters. The opportunity exists, but selection matters. The silver tsunami may create demand, but only high-quality healthcare REITs can turn that demand into durable investor returns. And boring money usually wins, because boring money usually survives.